Welcome everybody to this Thursday, September 14th, 2023 edition of Trading Places Live at earningsbeats.com. I'm your host, Tom Bowley, Chief Market Strategist here at Earnings Beats. And we're going to take a look at the market, pre-market, and see what we can expect for the rest of the day. Got a really interesting piece to show you to start the show. If you recall, yesterday morning, remember when I pulled up CNBC and I showed you the headline on the CPI and showed you that they didn't talk about the headline number because it matched? Instead, the headline was that the core CPI had actually risen more than expected. It was 0.3% versus 0.2%. And I also went on to talk about it was probably rounding. Well, I want to show you today. You can't make this stuff up. Hold on, I'm going to share. All right, so here's CNBC today. Let me scroll down and show you the headline from today. So now we got the PPI. So today, the August wholesale inflation rises 0.7%, hotter than expected. So let me show you the economic reports. So here's the PPI. So there's your 0.7%, and there's the estimate. So, hey, no doubt it was hotter than expected. What if we exclude food and energy and we just talk about the core PPI? Well, it came in at 0.2%, just as expected, lower than the prior month. But the focus today was on the headline number because it was higher. Now, yesterday, here was the number for the CPE. The headline number matched 0.6%. So there was no mention of that. Instead, where do they go? They go to the number, the core number, which was 0.3% versus 0.2%. And I looked at this and I said, well, the actual annual number came in as expected. So this 0.3 must have been some sort of a rounding thing. Well, here was the CPI, the new CPI. If you put in $, CCPI, core CPI, you can get the consumer price index over at StockCharts. Here is the 1 month rate of change, and there's your 0.28. So it actually came in 0.28, but they rounded up to 0.3. Had they just used the 0.28 number, it would have been closer to consensus, and there would have been no change. My whole point in this is that, and this is what I talk about all the time, I focus on the charts. Hopefully you all have been following me for a long time. Hopefully you follow the charts. We are minuscule to the number of people who trade stocks. I've said many times before, I go over to my local club where I golf and I sit down and talk with some people who are really smart, educated people, but they don't follow charts. They literally want to talk about the headlines. So they want to talk about the CPI that was high on that came out on Wednesday, or the PPI, which came out high on Thursday, except we're just nitpicking. The media is nitpicking what to write about. The 0.3% on the CPI was the number that was going to get the biggest reaction. If you go to the PPI, the 0.7 headline number, that's the number that's going to get the biggest reaction. So that's what they write about. That's the headline. Forget about rounding. Forget about the fact that the core came out okay on the CPI or on the PPI, or that the headline number came out okay on the CPI. We're not going to write about any of that stuff. We're going to write about what didn't work. We're going to write about the train wreck. And that's the problem I have with media, is you don't get the story. The headline is clickbait. It's always going to tell you the worst. They're looking for the worst thing that they can report on. And I don't know how better to explain it than looking at these two economic reports and how they took the one piece that was bad in the CPI and put that in the headline, and then took the one piece that was bad in the PPI and put that in their headline. Notice the annual, the year over year on the PPI, they're showing 1.6%. I'll show you later in the show. I actually have a higher number, and I see the PPI coming down really significantly. I don't know what the difference is. I don't usually look at the PPI, so I haven't researched why StockCharts is different. But you can see 1.6% annual rate on the headline number is very tame. But why talk about that when you can talk about the fact that the monthly actual number came in a little bit higher than expected? Anyhow, I mean, that just drives me crazy because, again, they're not educating the public. They're trying to get clicks. And to me, I mean, that's just not right. I mean, I could go on, but I already have plenty of time. So I'm just going to jump in to what went on yesterday. Actually, first, let me give you the some of the news. Of course, the PPI came out. Honestly, I have not even looked at the retail sales, which was a pretty big number today I should have been looking at. But I was so caught up in this PPI and the spin that was taking place, I didn't even look at the retail sales. So let me give you retail sales number. Came out just a little bit ago. Retail sales came in better than expected. 0.6% was the actual number for the month of August. The expectation was 0.2. If we strip out the vehicles, the number came in 0.6%. It was a rise. Expectation 0.4%. So again, where's the headline on the retail sales? Oh, wait, there's no bad news. Oh, sorry, we're going to not talk about that one. Anyway, I mean, it's just, I don't know what the right word is for it, but I find it very interesting nonetheless. Initial jobless claims, another one that we need to talk about. 220,000 was the actual number. Market was expecting 217,000. So that came in just slightly above expectations. I'm sure if everything was peachy on the PPI, probably we would have talked about initial claims rising by 3,000. But anyhow, we're done talking about the media, at least for right now. Let me move on to the market. Dow Jones Industrial Average yesterday finished down 0.2%, down 70. S&P 500 was up a little more than 0.1%, up about 5.5 points. NASDAQ 100 was up almost 0.4%, up 59 points. Mid caps down 0.6%, down 16 points. And the Russell 2000 down 1.2 points. But that was 2/3%. So there's your loser on the day, the Russell 2000. It's been flipping and flopping. Day before, Russell 2000 beat. Day before that, it lagged. Day before that, it beat. Day before that, it lagged. Overall, it has been lagging, though. This morning, last time I looked in pre-market, small caps were showing stronger early morning action. So I don't know what to tell you there. We'll see what happens in the fourth quarter. I'm sticking with my IWM prediction that it outperforms the QQQ in the fourth quarter, but we'll see. Transport stocks did finish up almost 0.2%. That was despite some warnings in the airlines group. We got another one this morning. I was talking about Delta yesterday because that's one of my favorites. It's actually in one of our portfolios. They warned today. So we're now getting into that second half of September. This is when we start to see warnings, and we got to at least be prepared for, what we might see in the over the course of the next 2 weeks. Some of it may not be very pretty. But anyhow, Delta Airlines was down. Also yesterday, I think it was Spirit and American Airlines both warned just higher costs. So it's not so much that business is bad. What I'm seeing so far, I haven't read all the details on Delta, but generally it's just, oil prices going up and their overall costs being higher. Let's see, what else do we have? How about utilities leading yesterday? So you might say, well, that's not good. Utilities are leading. Well, utilities up 1.2%, but overall, definitely not one of the leaders in the market. So I don't think we have to worry about that. Discretionary was the second best group. I mean, you talk about the chop that we've been seeing in the market since mid-July, the ups, the downs, the rotation. 1 week it's defensive, 1 week it's aggressive. Don't really know which way the market wants to go here, but it's typical. This is typical summer chop, mid-July, end of September. Good news is we're only a couple weeks away now. It's September 14th. So we just got to get through the next 2 weeks, maybe 2 weeks from tomorrow. And then at least the historical headwinds will be lifted. Real estate, the worst performing group yesterday, down 1.01%. still in an uptrend. If you look at the lows coming off March, and then again in May, and again in August, and then just yesterday, got an uptrend in place, but it's still not been nearly as strong. And since we topped in July, you can see this is one of those groups that has been leading us to the downside. Defensive groups leading to the downside. That doesn't worry me as much. Actually, when we're moving lower, I expect aggressive groups to move faster to the downside. And we really haven't seen that. Many of the aggressive areas have actually held up pretty well. Speaking of which, one of them in the consumer discretionary space is broadline retail, home of Amazon. This group is looking as good as it has in a while, breaking out to a new 52-week high, had a little cup, pulled back for a day, and then broke out. Nice move over the 3,000 level. The PPO, some might look at this and say, oh, but look at the negative divergence. And I'm going to say, oh, but look at the PPO reset. We went down, hit the 50-day moving average. PPO was back at zero. At that point, there's no momentum in the market. So we are now moving higher with a strengthening PPO. I don't look at this going back. And I gave a really good example. I don't remember if I did it in the live trading room yesterday or maybe on the show from yesterday morning. But I talked about divergences. And if you pull up a monthly chart on the NASDAQ 100, we're going to probably have a negative divergence until the end of time, because the PPO that we had back at the end of 1999 and early 2000, the monthly PPO, I think was 30, or maybe it was the weekly PPO. It reached 30, which means that your short-term 12-period moving average is 30% higher than your 26-period moving average, exponential moving average. That never happens on a long-term chart, because from 1995 to 1999, the market went straight up. So we're never going to see momentum like that. But yet, technically, if you want to go back and look at it, it's a negative divergence, and it'll always be a negative divergence, which means every time the NASDAQ 100 hits a high throughout the rest of our lifetimes, it's a sell signal. If you look at the strict technical definition of a negative divergence, which I don't. I use a little bit of common sense. When momentum slows for a period of time and you get your 12-period and 26-period moving averages back down to even, there's no momentum in the market. It's gone. Whatever negative divergence was in the past has now been resolved. So this move up right in here, you can see, came with a negative divergence. That is what I consider a real negative divergence. But after these 50-day tests and the centerline tests, it's gone. There's no more momentum in the market. We're starting new. I always use that analogy of a baseball game, a 3-game series. You know, if the Yankees are playing the Red Sox, the Yankees win 10-5 on Friday night. After the game's over, we go back to 0-0 the next day. You don't start 10-5 on Saturday. It's 0-0. We don't know who's got the momentum. We don't know who's going to win. Same thing with PPO and the negative divergences and momentum. Once it goes back to 0-0, you're starting over. Anyway, aluminum had a pretty good day yesterday, rising 1.6%. But you can see it's been a very, very weak group overall. Not a big fan of the materials as we go forward. I just, as inflation comes down, the price of many of these commodities has been coming down. I'm just not a fan. Airlines, honestly, I was a fan. This group is just all over the place. Looked very strong 2 months ago. Just continues to weaken and weaken and weaken day after day after day. Now with the warnings coming out, maybe it's a sell on rumor, buy on news. Maybe once these airlines all get their bad news out of the way, maybe they can focus on the fact that their business is strong. But right now, those additional costs are weighing on the group. Airlines down 3.05% on Wednesday. All right, moving on. Let's take a look at I'll just pull it up, the 10-year Treasury yield. So what happened in the 10-year Treasury yield yesterday, right? CPI, remember that headline news? Wow, the core CPI was higher than expected. Whoa. Well, yeah, we went up to 434 and then came back down, finished at 425. Now we're at 423 this morning. wait a minute, in both inflation reports, according to CNBC, were higher than expected. Shouldn't the 10-year Treasury yield be building in higher inflation expectations? What's going on? You know the rest of the story. Anyway, 10-year Treasury yield down a little more than 2 basis points. It's now down about 12 basis points from the high yesterday in the morning. The S&P 500, nothing. I mean, yesterday, trading right in the middle. I mean, trendless. This is what happens in a trendless market. Everybody's frustrated. Bulls want to see the market go up. It's not. Bears want to see the market come down. It's not. We're just going sideways. We pull up the NDX. Same thing. Little bit movement to the upside, but really nothing. Just sitting slightly above the moving averages. Both of the moving averages, by the way, sitting right on top of one another on the NASDAQ, within 24 points of one another. That's pretty close when you consider we're at 15,348. But again, this is a trendless market. We're going sideways. Let's see which way we go next. I believe the bears will have a chance here over the next 2 weeks. Beyond that, if we haven't broken down, I will be licking my chops, getting ready for the next breakout as earnings season approaches. How about IWM? So the IWM definitely was weak again. 7 days in a row now where the IWM is closed below the open. That's certainly a signal of at least short-term distribution, but we're holding on to support. And we've done this before. Had a bunch of filled candles, held on to all the support in the past, and ended up turning back to the upside. I believe that's what we're going to see here, but market still has to prove me correct. Right now, it's not proving me correct. It's proving me incorrect in the near term. And then the transports, obviously with the airlines struggling, transports went down to a new low yesterday, but they did bounce back, did finish slightly higher, even though the airlines were down more than 3%. The transports actually moved into positive territory in the afternoon yesterday and on some pretty big volume. Still don't know exactly where to call a bottom on this chart. So I'm just waiting for one to print, maybe move back up through the moving averages. We don't always have a signal that a bottom is in. Sometimes the market just turns around and goes back up and it's done moving to the downside. Maybe that'll be the case. I said before, I mean, here's a breakout just below 15,000. You got some really good support here, about 14.5. Those would be two areas that I'd look for if we do continue to drop on the transports. All right, chart of the day. So for those of you who are interested in the chart of the day, we do this every day on the show. We issue a chart of the day, our Earnings Beats Digest newsletter 3 times a week, Mondays, Wednesdays, Fridays. Of course, Mondays and Fridays are days we don't have shows. So if you'd like to get those charts of the day, just go over to earningsbeats.com, both plural, earningsbeats.com. Scroll down. We've got our area to sign up to the EB Digest, name and email address, all it takes, no credit card. So it's completely free. It's simply a way for us to give back. I try to teach things that I've learned over the years, things that I look for. I point out stocks that I like, gap. Sometimes a lot with earnings, we'll get gap support. That's really key. Try to talk about that. Intermarket relationships, sentiment, candlesticks, inflation, you name it. I'll from time to time, I'll talk about it. But anyway, it is educational. We'd love to have you. Hit that subscribe button. You can unsubscribe anytime. And if we do any free events, we always reach out to our EB Digest subscribers. So another reason for you to be subscribed. All right, what do we want to talk about today? Well, here's the dollar CPPI. This is the the core producer price index, CPPI, $2 in front of it. That's how you get it at Stock Charts. Make sure you put up monthly chart on and go back more than a year so you can kind of see what's going on with the PPI, core PPI. But the readings come out once a month, so it makes sense to use a monthly chart. Otherwise, if you use a daily chart, you're only going to see a change once a month. It just doesn't look right. Put it on a monthly chart. I've stretched this back 50 years. You can see the 12-month rate of change here, and then the 1-month rate of change down here. So there's the 0.26% 1 month rate of change. And there, now this is the difference I was talking about earlier. And even, well, if you're looking at the 0.26% and you say, well, how can that be? It was 0.7. This is looking at the last, it doesn't have today's report in it. So it's looking at the July report. Today was the August report that was released in September. What it's looking at, what the stock charts chart is looking at, is only through July. So the July PPI that was reported in August. Okay. So that's why the 0.26%. If you look tomorrow, it should be updated and you should get the actual number. But 0.26 should be the prior. And let me see, there is the PPI, and there's your prior, 0.3. They round over at econoday.com. So there's the 0.3. But again, here is, it was actually 0.26, got rounded up to 0.3. But this 3.96 is what I'm showing for the annual rate of inflation at the producer level. And here, if you look at the actual year over year, it's core. Core is 2.2. If you look at the prior, it was 2.4. So I should be matching up with the 2.4 for the annual. And instead, I'm looking at 3.96. I don't know why they don't match. That might be a question for stock charts, or maybe if any of you all know, write it in. Type in a comment, and I will get that later. But I don't know why there would be a difference here between what was reported last month and what stock charts was showing as of last month. But one takeaway you can, looking at this, is you can see that the core PPI has been dropping. The annual rate has been dropping now for about a year and a half, close to a year and a half. And the individual readings, maybe we've had a couple of little spikes in here, but those individual readings have been dropping. And these 0.2, 0.3 readings are right in line with what we've seen in the past here, going back years and years and years. Most readings tend to stay between 0 and 0.5. Obviously, we have some downside. And this is why we like to follow CPI more than PPI, because not all the changes in PPI get passed to the consumer. And so really what we're worried about is what we're feeling at the consumer level. And so that's why I always look at the dollar CCPI, the core CPI. And if we look here, first of all, you rarely see the CPI go lower. Go back over here to this PPI. Look at all these back in here. We saw lots of moves back below 0. Minus 0.6, 0.6, 0.6, 0.6, 0.4. Here's minus 1.3. And then you have a lot of others that are just maybe minus 0.1 or 2. Look at the core CPI. Very, very few. I count, other than the pandemic, when course prices were coming down because there was no demand, we shut everything down. 2017 and 2010 were really the only 2 months that we saw negative, dating back, except till you get all the way back down to back to 1982. So look at the core CPI. Look at the annual rate, 4.39% right now. So it's 4.4 rounded. And that includes the August. So if we pull up that that report, I'm showing prior was 4.7, and I'm now showing current as 4.3. So if I go back over here, prior was 4.7, now it's 4.3. I'm showing 4.39. Again, I'm not sure why it wouldn't show up as 4.4 rounded, but we're talking really not much difference there. But this kind of lines right up. And then here was your 1 month change, which is 0.28. So again, I put a monthly chart just to show you how you can set this up over at Stock Charts. Set it to monthly, put in dollar CCPI, core CPI, or CPPI for the core PPI. And if you don't want the core, you just want the headline number, I'm pretty sure you can just take out that C for the core. And there it is. So this should be the headline number, which right now is showing 3.71 on the CPI. So let's go back. All right, so the actual is 3.7, and we're showing 3.71. You see that right here, 12-month rate of change. So we're right on that one. I don't know why we're off on the PPI. I'll have to take a look at that. And there's the 1-month rate of change, headline number. Now, again, you can see the headline number can be a little bit more volatile. But if you go back in, we put in that C for core CPI, and we pull it up again. You can see there's not nearly as much volatility. And that's why the Fed looks at the core CPI, because oil prices are all over the place. I mean, they go up and down, up and down, up and down. Trying to measure whether or not we have inflation based on energy prices. I mean, we'd be in the worst inflation period one year, and then next we'd be in, deflation period because oil prices have been dropping for a year. Can't base it on energy. Yes, it's important to follow. Yes, you got to spend money on it. It comes out of our pockets. If it comes out of our pockets, it means probably we're not spending on other areas. If people have to start making choices and they have to spend too much on energy, maybe they spend less in other areas. I don't know. Certainly not a psychologist, financial psychologist. And the food is the same as energy. Food, you can have a drought, prices can skyrocket in certain areas of food production and pricing. So that's the reason the Fed strips it out. What is really happening at the core if we strip out these two really volatile areas? And so that's why you see less gyration back and forth. But look at what's happened during the pandemic. Since the pandemic hit, and I think this is all triggered by the pandemic. I think it started with a lack of demand, too much supply, nobody was buying. We shut everything down. And then all of a sudden, when we came back online, because we had shut everything down, supplies were dwindling, and all of a sudden demand shot up. So inflation 101 is too much money chasing too few goods. That's the definition essentially of inflation. And we went through that because of the pandemic. And I think we're returning back to normal. And that's what we've been doing. And that's what we've talked about. People that want to say, oh, we've got an inflation problem. Where was the inflation problem before COVID? There was none. There was no structural inflation in place. It was all due to the pandemic. And we're slowly working our way back to normal. I don't see inflation as a problem. And neither does the market, by the way, Wall Street. Or, I'm looking at stocks and bonds. Bond market certainly isn't expecting. There's no massive premium because of inflation expectations. Anyway, one last thought, because it is 9:30. Last thing I want to talk about is I'm going to show you the IWM and the TNA, because the IWM and the TNA tracks the IWM, right? Except it's 3-to-1. And I had a question come in and say, Tom, if you like the IWM, why don't you just hold the TNA? What if you miss the move to the upside and the TNA takes off? Why wouldn't you just hold the TNA and just not worry about the IWM, or, keep a certain allocation, maybe 70% IWM, 30% TNA? Why not just hold it? Here's why you don't hold it. When you go through a period of consolidation, the TNA loses value. There's erosion in these leveraged ETFs. And so if you look at where the IWM is right now, we were at 180, at 182.50, right now 182.97. And you can see we never went down below the prior lows, or we haven't yet on the IWM. And yet you can see this has gone back down below. If you come over here, you'll see that this low close was above this low close, but the TNA had a lower close. So anytime you're holding during a choppy period, like March to May, or like the period that we're seeing right now, when you see ups and downs, the TNA doesn't track the IWM perfectly. It loses when it goes up. It goes up, roughly 3 times. When the IWM goes down, TNA drops roughly 3 times. But if you do the math, you actually start to lose a little bit, which is called erosion. And so that's why I don't hold during what I think are choppy periods. Now, when the IWM, when I think it's either at a major bottom, and to me, that might be around this 179, 180 area, I'm going to get more aggressive. Or if it were to break out and start to show that, hey, it's starting an uptrend, like right here, we break out in July above this double top. That was a beautiful time to be in the TNA. So that's my thinking. I just don't like these leveraged ETFs. Another one, and this doesn't track exactly, but if we pull up semiconductors, the Dow Jones US Semiconductor Index, and I know the SOXL does not track that. I think it tracks the ICE Semiconductor Index, and I don't think I can get the ICE Semiconductor Index on stock charts. But if I'm just looking at semiconductors and I'm saying, okay, I love semiconductors, so therefore I'm just going to hold on to SOXL. Well, I want you to look at these 3 tops coming across here. Here are the 2 tops. Look at this one. SOXL is nowhere near. So if you're looking at the semiconductors and you're getting ready to break out at the end of August, the SOXL, you look and you're down $4 from where you were. Now, I'm not calling that erosion because, again, we're talking about a triple leveraged ETF that tracks something other than the Dow Jones US Semiconductor Index. It's really best when you can get the underlying index and the actual triple leveraged ETF that tracks that index. That's really what you want to have on a chart, and just start to track it and see, as you go up and down, up and down, up and down, you'll see that the index remains the same, or, maybe up 0.5% or down 0.5%. And you'll see that the triple leveraged ETF actually underperforms. And so that's why I don't want to hold. I just want to be in the IWM until I feel like we've reached a point where I can keep my stop really tight on the leveraged ETF, or get that move to the upside, and I need to be feeling good about a new uptrend starting. So that's it. Let's go ahead and take a look at the market here and what's going on as we open. Dow right now up 160, S&P up 20, NASDAQ up 52. We got small caps actually leading, small and mid caps doing very well today. So we'll see, it's their turn, right? Yesterday they were lower. I guess today is the day it's going to go higher. I mean, not only is the overall market choppy, but the rotation's been choppy. And so it's been a really difficult market. I don't know. I don't think I have anything else. Look at that VIX getting back down to closer to 13, about ready to break back down again. I mean, market's giving us so many signals that it's going higher. I mean, the media is trying its best. 2 days in a row, really bad reports, right? I mean, NASDAQ was up yesterday. It's up again today. S&P was up yesterday. It's up again today. Small caps were down yesterday, but they got it all back today. I mean, it's the news, creating maybe some morning weakness. But overall, I think the market continues to do really well. All right, that's it for me. I'll be back on Tuesday for your next Trading Places Live. Come check us out at Earnings Beats. I have a daily market report every day. I do a weekly market report now. I've done 2 weeks. Just started it 2 weeks ago. Very, very, very comprehensive report at the beginning of each week. Check it out. We got a 30-day free trial. Love to have you. And for those of you who just like to watch here on YouTube, please like the video below. That really helps us. Also, make sure you subscribe to the channel and turn your notifications on. Really would help us as a business. Give a lot to our community. We'd love to have you give a little back click on those buttons below. Anyhow, appreciate you tuning in. Have a great day. Let's see what happens rest of the day and into the weekend. We do still have second half of September upcoming, though. So let's be just a little cautious, walking on eggshells here a little bit. But I do believe we get into the fourth quarter, we're ready to run. Have a great day, everybody. Happy trading.